Gone are the days of a $100 barrel of oil. Now the focus is on making sure prices don't drop to the lows of 2016, when it dipped below $30 a barrel. And so far, it's going well. Oil prices have been rising since the start of the year, thanks to an agreement by OPEC and its allies to cut output by 1.8 million barrels per day. But there are concerns that as the market is still oversupplied, it could be suppressing a rebound.
So we're probably going to adopt a decision that allows us to continue the process that has worked so well in 2017 and allow us to meet the target that we put for ourselves.
And overshadowing OPEC's rebalancing roadmap is the rising output of North American shale producers. Rising oil prices have led to them getting more drilling rigs to boost their 2018 outlook. And more drilling means more supply. Shale producers have also started creeping into a market dominated by Saudi Arabia and Russia. In October, China's imports of US oil hit the second highest level on record, and they are expected to rise, further supporting US shale. As the largest non-OPEC oil exporter, Russia has been calling for a so-called exit strategy. This plan would prevent the market from suffering a sudden deficit of oil and overheating once supply and demand rebalances. And some analysts agree.
When they're going to scale that back, when they're going to put that quantity back on the market, how the market would react. I think that certainty also needs to be addressed by the cartel. Cartel needs to make sure that it provides a united front and a clear message how they're going to achieve the target and how they're going to come out of this.
The crude reality is there's a new normal in the oil market, one that producers will have to get used to. Laila Humairah, TRT World.
And we can go to that OPEC meeting in Vienna now. And joining us from there is Gaurav Sharma. He's the UK business editor at the International Business Times. Welcome back to Money Talks, Gaurav. Great to have you as always. How difficult or easy was it for OPEC members to get this extension?
Well, it's good to be back on such a crude and freezing evening, I should say, in Vienna. And I think the OPEC players in here, it was a done deal. I think by afternoon, all the analysts and the journalists realized that OPEC is firmly in the camp of rolling over the cuts. It was just how the non-OPEC players would react, especially Russia. And there had been some sound bites in the run-up to the meeting that the Russians were saying, well, the current deal still lasts up until March 2018, so why don't we talk later down the year, instead of just planning a 9-month extension. But as it transpires, it seems that they've gone along for the ride and that we now have a rollover of 1.8 million barrels per day, as your colleague mentioned, all the way up to the end of 2018.
How important is Russia for this agreement?
I think, to be honest, this is my opinion, not my publication's opinion, but I think Russia's presence here is of huge symbolic significance. How much they're contributing meaningfully is open to debate, because a lot of analysts out here think that they're doing a little bit of inventory jiggery-pokery. They're doing the natural rate of depletion is being counted into the kind of reductions that they've promised OPEC. But nonetheless, it was a symbolic move. So had the Russians not gone along for the ride, you would have seen an immediate run on the oil price.
Look, every time, as we saw in Laila's report, every time prices go up, we see the rig counts in the US go up. At what point will this agreement fail? At what point will the agreement, or look at it another way, at what point will this agreement actually succeed in lowering supplies beyond this agreement?
A very good question, and I think your colleague just alluded to what is the new normal. The new normal is not $100, the new normal is not $20. The new normal is the modest middle, somewhere where the oil price is stuck at the moment. And the moment the oil price tries to creep a little bit upwards, you see an upshoot in the United States. Now, American production has also been revealed this afternoon. It's somewhere in the region of 9.4 million barrels per day. And even the most pessimistic, I repeat, the most pessimistic forecast puts it at above 10 million barrels per day. So OPEC might well cut, but in the absence of an exit strategy, if shale production keeps rising, it will neuter whatever is attempted in the corridors of power in this building.
Just going back to the issue of Russia, how much of a concern is this to the producers of this friction that we see between Russia and the rest and OPEC? I know that Saudi Arabia and Russia have been cozying up quite a bit in the run-up to this meeting, but there are still some fundamental disagreements there, aren't there?
Well, there is some historic distrust as well. Prior to 2014, the previous Saudi oil minister, Mr. Ali al-Naimi, often attempted to reach out to the Russians, but to quote words from his autobiography, they promised much but delivered little. But something changed. The producers came together, realizing that the oil price was absolutely tanking. It became imperative for them to shake hands, and hence the Russians came on board. But, you know, wearing my analyst hat on, I don't think it will last very long because, as you mentioned, there are some niggles in there. The Russians can exit quite easily. They can simply decide, well, that's us done. It's OPEC that's actually lacking an exit strategy, because at some point it'll have to stop the cuts. And what happens then when all these additional barrels come in on top of the additional American barrels?
I see. Gaurav Sharma, thank you so much for your analysis. Gaurav Sharma of the International Business Times in Vienna there. Thank you.